Happy Friday out there, folks. This is Darius Dale here to present our macro minute for Friday, June 17th, 2022. Starting with markets this morning, we have stocks up, commodities mixed with agriculture leading, crypto down, dollar up, global bond yields mixed with U.S. rates leading, European rates lagging. Market moving headlines, don't short into OPEX. Today brings the quarterly triple witching when 3.5 trillion of options expiry may lead to short covering, which may bring temporary relief to the stock market. One dynamic that could counteract that is if investors in mass broadly reach for more protection by rolling those expiring in the money puts down in price and down in strike and out in time. We're not necessarily seeing a tremendous amount of demand for that. If you look at our friends over at Spot Gamma, their data, they're suggesting that we're seeing a flattening of skew, which implies that investors aren't exactly sort of rushing to establish new hedges. A lot of investors, as we've been talking about on this program and in our research throughout the year, have been generally very hedged throughout these market moves. We're obviously seeing a lot of damage, but in terms of the need to hedge incrementally here today and early next week, we're not necessarily seeing that. At least that is not the case thus far. We'll see. So just want to remind you, don't shorten OPEX, particularly in a bear market. Bear market rallies are very aggressive. We talked about that. We did a big deep dive study on all the historical bear markets, all the major historical bear markets over the last 100 years. And what you typically find is that you have a lot of vicious relief rallies. These major bear markets tend to have anywhere between 10 to 12 to 15, rallies of significance en route to being cut in half. And so we definitely want investors to be aware of those kinds of dynamics. Don't get chopped up in a bear market. You're better off taking your ball and going home than you are shorting into the lows of OPEX. Recession is actually the bull case here. So investors continue to pile into U.S. equities for all the talk of a bear market and recession. U.S. equities attracted $14.8 billion in the week to June 15th. Their sixth consecutive week of additions. This is Bank of America citing EFPR global data. In total, $16.6 billion flowed into equities globally in the period, while bonds had one of their largest redemptions since April of 2020 at just over $50 billion and just over $50 billion exited cash. So investors are taking cash out of they're selling bonds and taking their cash position down to buy the hell out of stocks. We think that is a very, very bad decision at this particular juncture. In terms of the medium-term process, we do not believe we've priced in the most adverse consequences of the liquidity cycle downturn, particularly as it relates to the growth cycle and the profit cycle. We think that those two dynamics will represent the next leg lower. But again, as I mentioned, with this OPEX coming up, you don't necessarily have to price in that next leg lower today, tomorrow, next week. There is a process. This is a large process. But as I talked about on Pomp and on Real Vision in recent weeks, a recession would actually be a bull case. If you actually started to see real recessionary-like conditions, what will likely happen is that it'll really start to weigh and break the back on not only reported inflation, but also medium to longer term inflation expectations, which will obviously speed up the process of the Fed pivot, the speed of the process of a Fed pivot back to being dovish. But again, I don't know that we're there yet. We certainly haven't seen enough data to support a real recession there. Although one thing I do find is really interesting, and we talked about this earlier this week, which is we had a negative print Q1 GDP print for Q1. We're basically tracking it flat for Q2, and probably that Atlanta Fed number is going to go negative by the time we get all the rest of the data for the second quarter. Technically speaking, and then I'm using the word technical specifically, that would be a recession. A technical recession is 2 consecutive quarters of a negative GDP print. Again, I don't think a technical recession is going to cut it from the perspective of breaking the back of inflation. You need an actual recession, the kind of recession that gets the old folks who blow dust off of books at the National Bureau of Economic Research to come out and say that, my friends, is a recession. And typically that's marred by substantial deviations from trend in output and substantial deviations from trend in employment. And very clearly, we have not seen either of those yet. And so just be aware of that. Big movers, Ethereum down 2%, another 2% to down basically yet again cut in half month over month. I mean, holy crap. I mean, that's I don't know, this Web 3.0 thing or the Ethereum fork or whatever, sorry, pardon my ignorance on those dynamics. Again, I'm a macro guy, not an on-chain guy. that stuff can't come soon enough. I mean, I know a lot of folks bought the highs in Ethereum this year and the highs of, this year, expecting that to be the bull catalyst. And the reality is, unfortunately, if that's all you pay attention to, you're learning the lesson the hard way, that if you don't do macro will most assuredly do you. And hopefully, you tune into this program and subscribing to our research has been very value added to what has otherwise been a very difficult year to risk manage. One thing I wanted to call out as well, high yield credit spreads. This is the move from yesterday, up 31 basis points yesterday. That's a big move in credit spreads terms to 5.08% or 508 basis points over similar maturity treasuries when you adjust for the call options on the credit. Recall that 5.37 was the high in the Q4 18 downturn. Actually, that number was from early January of 19, but it was the high in that Q4 18 downturn that we called out back in my prior shop. We do a great job, and certainly here at 42 Macro as well, of getting you out ahead of time. But one thing I would call out, just in terms of one, we are lower than where we peaked in credit spread terms and high yield terms than where we were in that sell-off. And just from the perspective of the liquidity cycle, the growth cycle, and the profit cycle, this is a much, much worse setup than what we saw in 2018. So I think we're going to see an incremental widening of credit spreads from here. But again, with respect to these OPEX dynamics, probably not in the very near term. Looking at our volatility adjusted momentum signal and probable range processes, US dollar, that is bullish fam, is no longer overbought. Got 0.8% downside, 2.1% downside, 0.8% upside in this probable range. Gold, that is bearish VAMs, minus 3.7% of downside versus 1.5% of upside. 10-year nominal Treasury yield bullish VAMs, no longer overbought either, minus 29 basis points of downside, 19 basis points of upside. High yield OAS, high yield TDX, neutral VAMs here, still overbought here, minus 112 basis points of downside to the lower bound of its probable range. S&P 500 bearish VAMs, that is still oversold with 9.8% of upside to the upper bound of its probable range. Neutral VAMs VIX is overbought here with minus 30% of downside to the lower boundary of its probable range. NASDAQ 100 nearly overbought, or nearly oversold, with minus 1.7% of downside and 10.9% of upside. Russell 2000 flipped back to bearish VAMs this morning. It's oversold with 11.5% of upside to the upper boundary of its probable range. Bitcoin bearish VAM still deeply oversold with 37% upside to the upper boundary. Ethereum bearish VAMs deeply oversold with 52% upside to the upper boundary of its probable range. Probably not going to get there, but again, could you get a bounce if we get a sympathy rally in OPEX? Certainly. Shanghal Composite neutral VAMs. This looks like an economy that's reopening eventually. So you got 5.2% of downside with 0.9% of upside. Then talk about crude oil bullish VAMs here. Bounced off the lower boundary of its probable range. Now it's got 3% of downside versus 10% of upside. This is probably, if you get a China reopening trade, that's maybe catalyzed and ignited by this OPEX dynamic. You could see you're likely to see new highs in crude oil and a lower highs and some of these beleaguered risk assets that we've done a great job of getting you out of here and putting your shorts on as well. Let's not forget we're making a ton of money on the short side as well here. Agricultural neutral VAMs. That's minus 3.6% of downside versus 2.7% of upside. And then industrial metals, bearish VAMs, that is oversold as well with 8.8% of upside to the upper boundary of its probable range. So with that, Darius Dale presenting our macro minute for Friday, June 17th, 2022. Best of luck out there. Everyone have a great weekend. And just a reminder, U.S. markets will be closed. We'll be offline on Monday for celebrating the Juneteenth holiday, and it will be a celebration. Cheers.